one of the things I want to bring up to you is the year 2008, because that's a year, I got into business in '99 and it was pretty smooth sailing. 9/11 was pretty crazy for us, but 2008 is a year I'll never forget, because that year things changed immediately, right? The stock market, everything changed. People's mindset changed. Confidence left the system is really what happened in 2008, right? You couldn't get a bid for IBM stock. It just seemed like you couldn't really get liquid if you needed to. Interestingly enough, at that time, the stock market got cut in half immediately. It took about 8 months, but it happened quickly. Most notably, what we saw, and as I told you, we only deal in physical metal, okay? What we saw happen was the price of silver on paper. And when you look at CNBC, you see the price of silver go across every day. That is a price of a futures contract, okay? A futures contract, for those of you who don't understand it, is simply a paper agreement between me and you. And I tell you, okay, in 3 years, I'm going to deliver you 10,000 ounces of silver at this price. But the problem with the futures market is, and we know for a fact, they have promised out on paper dozens of times more silver than they ever could hope to deliver. What we think is going to happen sometime in the next several years is these people who own these futures contracts, for whatever reason, are going to begin to call for delivery of those futures contracts. Instead of you saying, okay, I want you to send me that 10,000 ounces of silver. I don't want another paper promise. I want my silver now. Okay? We're starting to see signs of that. And in 2008, what happened to us was we saw the price of silver on paper, the futures price, fall from 20 to 9 in a matter of a few months. The law of supply and demand and common sense tells you that if something falls from 20 bucks to 9 bucks, that nobody wants it, and there must be silver everywhere, right? That's what you'd be led to believe when you see the price of something fall, let's face it. But I can tell you, and Jake could tell you because he was on the phones, that was exactly not what happened. What happened was we couldn't put the phones down. People were calling us up. They wanted silver now. We sold massive amounts of silver. One of the slides you'll see here is 100-ounce bars that we gave a guy. The fact of the matter is, we saw an anomaly in that the price was falling, yet the demand had spiked to an incredible level, and we could not get silver. In fact, the picture that we have in here is a picture of a 10,000-ounce silver deal that we did. It took 100 days to take delivery of that deal. Well, that was only $100,000 worth of silver, right? It's not a lot of money in Wall Street terms. It's not a lot of money in investment terms. But in the silver market, when things were tough, it took us 90 days to take delivery of 100-ounce bars. That's when we started looking at this and saying, something's weird here. And so, in the advertisement we sent you, an insider's perspective, what we're trying to do is give you and shed some light on this topic of what we really saw happen in the market, as opposed to just what's happened to this paper price you see on TV. I can tell you there's a difference between reality and the paper price, and we'll get on that in a second. And the fact of the matter is, in Shane's book, he talks about this an awful lot. So in 2008, confidence went, our sales went crazy. We had a hard time getting physical metal. It really went bananas. And then, so for example, when silver was $9, there were certain coins that we were having to pay $16 and $17 for just to get them. People were paying premiums for physical because they wanted the actual metal. Now, of course, silver's tripled from 9 to 30, or a little more than tripled, but the reality was, as the price was falling, demand was growing and there was no supplies. That, to me, as an economist, concerning. Okay, so what you need to know about gold is that the float is minuscule. The float means the amount that's available to be bought. Earlier I told you that there was $8 trillion worth of gold above ground in the world today. And I told you of that $8 trillion, maybe 10 to 15% actually trades. There's a quote here from Alan Greenspan saying, because the gold market is so small, a very small segment of people are capable of driving up gold prices. That came from Greenspan right out of his mouth in 2006. So let's look into that a little bit deeper. Gold history. So what happened for gold over the past 30, 40 years? Well, in 1933, after being our currency for many years, we used to make our gold coins, our currency in gold and silver coins. We have some back there. In 1933, when the Great Depression started, it was recalled. Okay? It wasn't even able to be owned in this country until 1974 when they opened the market back up. So what happened between 1971 and 1980? That was the biggest bull market in gold that we've seen up to this point. The price went from $35 to $850. All y'all know better than I did what happened in the 1970s. I was born in 1976, but I'm told that there was gas lines and there was inflation, and they were factoring in real inflation numbers, and people were freaking out. So that's what caused gold to go up then. There was a deep distrust of the dollar. There was a weak-kneed Fed. The Federal Reserve really didn't know what to do. The problem was out of their hands. Vietnam deficits, war costs were very high. Oil and wages surged, the gas lines. And the U.S. balance sheet at that time, meaning the amount of assets and the amount of debt we had, was far different then. I think that's a big point to understand. Right now, the debt level is incomprehensible. But back in the 70s when gold went up, it really wasn't that bad. So you got to keep that in mind when you're comparing the two decades. So between 1980 and 2000, gold dropped. There wasn't really a need for it in the world. Why? Well, there was a 20% interest rate. You put your money in the bank, you know, you're making 15%. That's a pretty good guaranteed return. People had confidence in the banking system. You're actually being compensated for risk. You can put your money in the bank and make money. I mean, what are you making now? 1/4% or something? I mean, it does nothing for you. Yeah, right. I'm telling you, it's pretty incredible. We have a lot of clients that are just dumbfounded because they haven't seen anything like this. So, you know, world peace, everything was fine around the world. Gold mining production boomed, so there was a lot of supply coming online. And then the European banks, they dumped their gold. In fact, we were in the market in 2000, and the Bank of London sold all their gold at $250 an ounce. They couldn't have made a worse move. They did that in like 2000. That was really bad. So that was like the bottom of gold. When they dumped, somebody sat there and mopped it all up, and now, ever since then, everything's turned around. This new bull market that I've been a part of since the year 2000. What's happened since then, right? The dollar has been falling against other world currencies, right? Not so much the past month, but we'll talk about that here in a minute. But the dollar has weakened for sure due to debt. Mining supply has fallen off. It's costing a lot more money to go down and get that gold out of the ground. Just the cost and mining cost and fuel cost and everything. I mean, the easy gold's been gotten. Now they're having to go really deep to get it. ETFs, electronically traded funds, everybody know what I'm talking about? You can go and buy GLD or SLV like a stock. It's paper gold is what it is. That has really opened up the investment world, and funds like my buddy Shane, that's the way they buy gold, at least right now. I think a really interesting point to make is that UTIM code, which is the University of Texas fund, it's like the pension fund for UT, got $20 billion. Well, they made a move, I guess it was early last year, where they took 5% of their money, which was $1 billion, and didn't buy ETFs, they didn't buy futures, but they bought physical gold bullion bars. I know a couple people on that board, and I know why they did it. I know that they're buying gold for themselves, and that was the first major fund that ever did anything like that. We think there's going to be more of that coming. Basically, gold underperforms. Gold doesn't do well when investment yields are high, when you're rewarded for risk. Gold doesn't do well when inflation is falling. Gold doesn't do well when the currency is stable. Gold doesn't do well when the economy is healthy. And gold doesn't do well when you have a peaceful global environment. Right? I think we all can agree on all those facts. Gold will do well, or outperform, when there is no risk reward. When inflation is rising and the dollar is weakening. It's a textbook thing. Dollar goes down, gold goes up. You'll see gold go up, the dollar goes down. When you have a turbulent period in financial markets, or you have something like a 5 Sigma event, terrorist attack, 9/11 type thing. Certainly we hope that doesn't happen, but it has and it could. The bottom line on gold in our mind is it's always about supply and demand. And if you have demand rising, and I think we're going to show you facts that is happening right now, gold will go up. If there's not a lot of demand for it, because it is a very simple asset, and it's going to go down if there's no demand. The thing you need to know about gold, or any market for this matter, it'll never be me or you or our best clients that make markets move. It's big money. It's pension funds. It's insurance funds. It's central banks, like the Bank of China, the Bank of Russia. If you take all the money that's managed globally, and I'm talking about by funds like my buddy Shane or any of these pension funds, if you take all that money and put it in a pie, or just add it together, we're thinking that number's around $200 trillion. Okay? what percent, and this is a question I'll ask you guys, and last time somebody got it right on the nose, I was blown away. What percent of that 200 trillion do you think right now is currently positioned in gold? Anybody got a guess? You're thinking? Anybody got a guess? 2%?
I would say less than 2%, we might be guessing.
A fraction of a percent.
That's right. It's under 0.5%. Okay. So think about this. There's 8 trillion out there. 7 trillion of it isn't moving. Then you have Russia come out last week and said, we just bought 570 tons of it. China's buying it. They're now the largest gold miner in the world. They buy everything they mine and half of everything else everybody else mines. Okay? That's pretty strong support for gold here at 1550, if you ask me. I don't see banks buying Google stock or buying Apple stock, but I do see them buying gold. And then when you see UT coming in and taking $1 billion worth of bars off the market, and then you start to see this, well, you have to ask yourself, do you think that's going to continue? Do you think things are going to get better in the short term? Do you think we're going to start paying down the debt? Those are all decisions that you need to give serious consideration to. I think the writing is on the wall. I think if you do the math on the deficit, it's hard math to figure out, and it's a hard problem to solve. The bottom line is, if there's more demand coming online for the little amount of gold that's trading, it will go higher. It's that simple. This is a great chart. What this shows here, and I want to show you the difference between reality, what we deal in, and what I don't think is actually accurate. So what this is, it's U.S. Mint data showing gold and silver purchases by the U.S. Mint, which is the United States Mint that makes gold and silver coins. And what you're going to see here is, here was the election last year in November. And what's really funny is, after that election came on, the price of gold went down a little bit. But if you look at the gold sales by the U.S. Mint, it shot through the roof. That's odd. It's odd to me that demand and trackable, traceable demand and the amount of coins they sold goes up like crazy, but yet the price of it goes down in the paper market. That's, to me, a little odd. This is astonishing. This is something I got yesterday. The U.S. Mint strikes gold coins, they strike silver coins, and they strike some platinum, not much. So we've been selling so much silver, I gotta tell you, it's been crazy. I can remember back in 2000, months would go by and I wouldn't sell 500 ounces of silver. But now it's like every day. I mean, we just sell hundreds and hundreds of ounces of silver a day. I guess in 2008, the U.S. Mint made about 10 million silver eagles. In 2009, the number went to 20 million. In 2010, about 30 million. 2011, 2012, 40 million coins. So going into this year, they knew that demand was going to be high because they could see what happened to gold at the end of last year. So they ramped up production for 2013 silver eagles. And they had 6 million coins ready to go the first week of January to sell to guys like us. In 2 weeks, they were all eaten up. They were gone. They were sold out. Our premiums went up to get them. We couldn't get them for about a week or two while they went in there and struck more. What we have here is a record the first 2 months of this year for silver eagle sales. Okay? They've minted over 10,800,000 silver eagles that have all been sold in the first 2 months of this year. That puts us on track for 65 million silver eagles this year. In the last month, the price has been knocked down 10%. That doesn't make sense to me. I'll let you figure that one out. To me, that's weird. And that causes concern. It raises alarm. And we tell that to our clients, and they think that's pretty weird. Okay. Any questions about anything I've gone over so far?